Hey there, fellow finance enthusiasts! Today, I want you to focus your time now for this one-of-a-kind analysis and be inspired by the extraordinary Colin Stewart, the superhero of finance. Are you ready to witness the rise of a true financial superhero? Meet Colin Stewart, the Iron Man of the financial world, armed with unparalleled analysis and an extraordinary ability to predict economic trends. With his state-of-the-art economic gadgets and unmatched intellect, he fearlessly confronts the challenges that lie ahead. From declining GDP growth to shrinking consumer spending, rising unemployment rates to the mysterious inverted yield curves, Stewart stands as our beacon of hope. Together, we will conquer trade tensions, debt burdens, manufacturing woes, and the unpredictable stock market, guided by Stewart's superhuman insight. So put on your cape and join forces with Colin Stewart, the invincible hero of finance, as we prepare to confront the imminent recession and emerge victorious on the other side. Now, let's start by addressing the burning question that has investors on edge at the start of this week. Should they be concerned about the outcome of these talks? And the superhero of finance exists, as he is now ready to bestow upon us his wisdom and expertise. Enjoy the journey of enlightenment, as Colin Stewart's profound insights illuminate the path, leading us through the intricate maze of complexities and uncertainties surrounding this pivotal situation.
I mean, it's one of those risks. It's hard to handicap, but it's something obviously a pretty small probability. We rarely see or I think never see it in the U.S. Breach that debt ceiling, and there's always a lot of consternation and worry right up to the deadline.
Get ready to explore the world of significant economic concerns as we shift our focus to the bigger issues at hand. But before we do, let's revisit an intriguing topic discussed with the superhero of finance, Colin Stewart. He has consistently held the belief that a North American recession is on the horizon. Now let's find out why he remains steadfast in this conviction and turn our attention to the pressing question at hand. What implications do these developments have for investors? Join us as Colin Stewart unravels the intricacies of these warning signs and provides insights into their potential impact on various sectors and the broader economic outlook. Brace yourselves for an enlightening exploration of the factors contributing to the anticipated North American recession.
I'm not necessarily talking about a deep 2008 type recession, but there are a number of warning signs we see on the horizon, and I think importantly, it doesn't appear that the equity market is pricing in too much of that risk.
Are we witnessing the replay of the infamous 2008 recession? The signs are hard to ignore. Walmart and Target are waving their red flags, shouting about dwindling demand. Even transportation companies are seeing their volumes take a nosedive, while the service sector is holding strong. There's this nagging worry that it might lose its mojo. And what about the Federal Reserve's attempts to calm our nerves? Well, it seems like their rate-hiking magic isn't quite cutting it. Brace yourselves, fellow finance enthusiasts, because it looks like we're headed for a bumpy ride. So here's the next scoop. The Federal Reserve is dropping hints that they might finally be wrapping up their rate hiking cycle. But hold on a second. Would that actually change your perspective if they came out and declared, "We're done"?
Well, no, I think the market largely expects they are done now,
Right.
and very likely that they're going to just pause for a long time here. And, obviously, I think if they see, start to cut rates, it's likely in response to a recession or a real weakening in the economy.
Colin Stewart sees it as a wild ride, just like Stewart trying to be Iron Man. While the Fed's hints of ending their rate-hiking escapades might give a glimmer of hope, the market is still eyeing potential risks like a hawk. It's a delicate tightrope act, juggling economic realities and market expectations without crashing and burning like a poorly engineered Iron Man suit. He knows he can't rely on superpowers alone. He must navigate the treacherous terrain of the market with precision and wit, just like Iron Man maneuvering through a minefield of economic uncertainty. Will he emerge victorious, a hero of investment strategy, or will chaos reign supreme? Time holds the answers, as it does for Iron Man's fate. Will this audacious performance result in a resounding success or a hilarious faceplant? Only the unfolding chapters of this absurd adventure will reveal the outcome. So sit back and watch as Colin Stewart channels his inner Iron Man in this unpredictable market theater. Let's find out the types of equity exposure. We're excited to hear your insights on equity exposure in the current climate. What types of equity exposure do you believe are advisable? Your perspectives are invaluable as we explore this topic. So, what are your thoughts?
Yeah, I mean, it obviously really depends on the type of client, the age, stage, all those types of things. But I mean, our view is it's a good time to be A, in defensive type sectors, B, holding some cash. I mean, there are obviously a lot of good alternatives for cash these days, treasury bills, money market funds, things where you can earn a higher rate of return. And so I think the bar is set higher for equities, and, whether it's utilities or consumer staples, defensive type businesses that would be less economically sensitive and sort of those types of sectors. And I don't think it's a bad time to be holding some cash as well.
Okay.
He emphasized the importance of taking a defensive approach and holding cash when considering equity exposure in the current market environment. He highlighted that the suitability of equity exposure depends on factors such as client type, age, and stage in life. Stewart suggested that defensive sectors, such as utilities or consumer staples, may be less economically sensitive and therefore worth considering. He also mentioned the availability of attractive alternatives for cash investments, such as treasury bills and money market funds, which can provide a higher rate of return. Overall, Stewart's insights encourage a cautious and diversified approach to equity exposure. Colin Stewart's extensive analysis leads to a rather amusing conclusion. All the indicators are unmistakably pointing towards an impending recession. It's as if the economic stage is set for a serious downturn, with various factors aligning to sound the alarm bells. Stewart emphasizes the concerning decline in the gross domestic product, GDP, growth rate across multiple countries. The economy seems to be hitting the brakes, suggesting trouble lies ahead. Furthermore, there's a noticeable global decrease in consumer spending. People have become more cautious with their wallets, opting for prudence over splurging, which reflects a weakened economy. Stewart also highlights the rising unemployment rates, a telltale sign of economic struggle and reduced overall activity. It's as if the job market is going through a rough patch, leaving individuals in a state of uncertainty. Moreover, Stewart relies on the inverted yield curve as a crucial piece of evidence. This phenomenon occurs when short-term interest rates surpass long-term rates, historically preceding economic downturns. It's like a warning sign blinking on the economic horizon. Trade tensions and geopolitical instability are additional factors Stewart identifies as potential catalysts for an economic downturn. These disruptive elements have the power to hamper global trade, leading to decreased economic activity and increased uncertainty, further fueling the risk of a recession. Stewart also underscores the impact of elevated levels of corporate and household debt. The heavy burden of debt on both businesses and individuals can strain financial stability, potentially triggering a full-blown economic crisis. Additionally, there's a noticeable decline in manufacturing activity and business investment. This decline suggests an economy on shaky ground, with reduced confidence in future growth prospects. Lastly, Stewart notes the volatility in financial markets and declining stock prices. Increased market turbulence and falling stock values indicate a lack of investor confidence, which can worsen the effects of a potential recession. In summary, Colin Stewart's analysis paints a vivid picture of an impending recession. The accumulation of various indicators strongly suggests an economic downturn, making it crucial for individuals and policymakers alike to be prepared for the potential challenges that lie ahead. Remember this Colin Stewart's mantra summary: stay vigilant, adapt with the tides, and always seek opportunity amidst uncertainty. In other words, unleash your inner superhero, embrace the unknown, and soar towards opportunity. So let's channel our superhuman abilities, embrace the unknown like the daring heroes we are, and zoom towards opportunities like a superhero in pursuit of justice. With Colin Stewart's mantra, we'll conquer the market's obstacles, all while wearing our invisible capes and sporting a heroic grin. Up, up, and away. What do you think about this topic? Let me know in the comments section below. Don't forget to like, share, and subscribe to Finance Zoo channel. I'll see you in the next video.